Okay, this video covers the revenue recognition complication of breakage revenue. Hey, do you have a drawer at home with gift cards in it? Do you think it's possible that you might not ever use some of those gift cards? Maybe you forgot that you have it. Maybe you don't even really like the company that issued the gift card. Somebody just gave it to you as a gift. But you might never use it. Well, put yourself in that company's shoes. They might fully expect that you have this gift card in your drawer and that you're never going to use it. Do they have to let that deferred revenue sit in the deferred revenue account forever? Or at some point, can they just assume that you either don't like them or you forgot about the gift card and you're never going to use it? Can they just recognize that revenue and get it over with? The answer is yes, they can recognize the revenue. It's called breakage revenue. And here's the rule. You can recognize breakage revenue when the customers have prepaid, so this is a deferred revenue situation. The customer's already paid cash. Now we're just waiting for them to exercise their rights. But if the customers are never expected to exercise their rights, then you can recognize that amount as breakage revenue. And let's just go through an example of the disclosure of breakage revenue using this company as our example. So Starbucks. I know I have lots of Starbucks gift cards at home. I've got nothing against Starbucks, but my employer that I used to work for used to compensate us with Starbucks gift cards instead of giving us bonuses. So if you work really hard, maybe you put in an 80-hour week or you pull an all-nighter, instead of giving you a bonus on your paycheck, they'll come and hand you a $5 Starbucks gift card. So I accumulated some of those and then never really used them. So how does Starbucks account for that? Let's go through the journal entries. So first, let's assume Starbucks sells a $20 gift card. When you sell a gift card, you debit cash for $20 because you receive you being Starbucks, the company receives $20 in cash. And rather than recognizing the revenue right away, you have to stick it in a deferred revenue liability account because you haven't earned it yet. Starbucks needs to deliver coffee to you before they've earned that revenue, and so it's sitting in a liability account. Well, now let's say time has passed. Maybe you've used $15 of that gift card and you've lost it. And Starbucks has a pretty strong suspicion that that's what happened. So time has passed and management now expects that that $5 remaining on the gift card is just simply never going to be used. And they've got some historical experience with this. I mean, they sell probably millions of gift cards, and they know the usage pattern. If a gift card hasn't been used for 2 years, they probably know the probability that it will not be used in the next so many years. So here's the journal entry they would do when management honestly expects that $5 will go unused. Well, they'll recognize that $5 as revenue. They'll debit the deferred revenue account, taking it out of deferred revenue, and credit some account on the income statement. Now I've put revenue here. It doesn't necessarily need to be the revenue account. Sometimes companies, rather than crediting revenue, will credit an income statement account, something like selling general and administrative expenses. Just kind of a general expense account, but not revenue. That's not the important point. The important point is that now this balance that was in deferred revenue can finally go on the income statement. Even though they haven't earned it yet, they haven't satisfied any performance obligations, but it doesn't need to stay on the balance sheet forever. It can come onto the income statement as a credit. Here I have a credit to the revenue account, and it can flow into retained earnings. And so that's how companies recognize breakage revenue. Now let's go through Starbucks' 2017 disclosures on breakage revenue to see how significant this is. Here's Starbucks, an excerpt of their balance sheet. This is the liabilities section of the balance sheet. And for October 1st, 2017, here's all their current liabilities. And see if you can find the current liability we're talking about here. It's right here, this white line here, called the stored value card liability. The stored value card liability. That's what they call their gift card liability, or that's what they call deferred revenue. And so this account at October 1st, 2017 has a balance of and this is in millions, so this is $1,288,000,000. That's the amount of gift cards sitting in people's wallets and drawers that have yet to be used. So out there in the world on October 1st, there were almost $1.3 billion worth of gift cards just waiting to be used. But what we're interested in is the year 2017 itself. And down here is where I report the details there. And this detail was reported in their footnote, and I've kind of summarized it for you here. They recognized 2017 breakage revenue of $104.6 million. So that's the amount of money worth of gift cards sitting around that Starbucks now assumes, as of 2017, assumes will just simply never be used. And so they recognized $104.6 million of breakage revenue in 2017. How significant is that for Starbucks? Well, in 2017, that represents 0.5% of total revenue. And so $1 out of every $200 of Starbucks revenue is actually breakage revenue. And so this type of disclosure can give you an idea of at least give you an idea of the gift card program at Starbucks and what maybe it's a profit center above and beyond just selling coffee. So this has just been an example of breakage revenue, and the summary is that yes, once a company expects deferred revenue, a customer will never exercise their rights. That's the focus of the deferred revenue account. A company can transfer it into the income statement, and it's called breakage revenue.